Welcome to Bequest Funds. We're here to talk to you today about our latest fund, which is our income fund. We're super pumped about it. It's been open for about a year now. And the intention of this fund is to provide consistent income with real estate notes, whereby we're paying our investors an 8% annual preferred return on a monthly basis. Before we kick off the presentation, let's go through the standard disclaimer that we're not here to sell or offer any form of security or provide any investment advice. You should always, seek a financial advisor, a CPA, an attorney for, for any type of advice or before you make any kind of investing decision. And anything we express in the way of past performance is not an indicator that the future performance will be equal to that. So for myself, my name is Martin Sines, and I am a co-founder and managing partner for Bequest Funds. And I want to first thank you for taking time out of your day to hear about our income fund and to understand if it's a match for you and what your investing preferences are and goals and objectives. And so, welcome. For myself, in terms of my background, my wife and I founded a government contracting company in the DC area by which we sold to the federal government in the mid 2000s. And we, as we were serving the federal client on a prime level, we also accumulated a portfolio of commercial and residential properties in the DC area that we still manage today. Academically, I got my MBA from Drexel University in lovely Philadelphia. And I also have a master's in project management from George Washington University. Now, as it relates to the government contracting company, my wife and I started building a family in 2012. So we sold our company in 2013. And from that point, I launched a company called Second Chance Funding, by which I would buy distressed mortgages from across the United States. These are mortgages whereby the borrowers had not made a payment in 4 or 5 years. And I would work with the homeowner to understand what they could afford to pay. And then I would create loan modifications and other creative solutions to help the homeowner stay in their homes while making a profit for myself. And this was achievable because I was able to buy these distressed mortgages at such a deep discount. It allowed me to have flexibility to make concessions to work with borrowers' budgets and create solutions that they could afford and maintain payment on. Through the course of purchasing and working out 1,000 loans, over 1,000 loans myself, and building my company, I managed to write several books on the industry, and most notably the best-selling book Note Investing Made Easier, that's still a big seller on Amazon. And so through the course of my journey, I hooked up with Sean Munyo, my partner, and he's also a co-founder with Bequest Funds. And he came with 20 plus years in the finance field and technology field, where he worked for several Fortune 500 companies. He has education-wise, he has his executive MBA from the University of South Florida. And really, when we started working together 4 years ago, he brought a lot of technology, a lot of project management, a whole systematic approach by which we were able to work together for and achieve scalability. that was very positive for both of us. And past few years we've purchased $25 million worth of mortgages from the secondary market, which I'll go into in just a moment here. So that's a little bit about myself and Sean. Our company, and as well as ourselves, we reside in the Sarasota, Florida area. So if you are ever in Sarasota, we'd love to have you come by our offices. We're right across the street from the marina in downtown Sarasota, and we love it here. We consider it paradise. And so with that, let me go into the secondary mortgage market. Now, the secondary mortgage market is very diverse. So for the purposes of our discussion today, I'm only going to speak about the secondary mortgage market from the perspective of reperforming mortgage loans, because that is what's going to be applicable to you as a potential investor into Bequest Funds. Now, everything starts in the primary mortgage stage. So that is where you have homeowners that, want to, achieve the American dream. So they go out and they buy a home, and in the process of buying a home, they connect with a banker lender who's the originator of that mortgage, so that they can have the money to go out and buy the home. Now, at some point, some of these mortgages go and move into a defaulted stage. So that is, essentially the borrower stops paying. And normally the borrower stops paying for one of three reasons. And that is love, they go through a divorce or some type of relationship breakup. Employment, they lose their job or they become underemployed. And health, something goes awry with one's health. And they stop making payments at a certain point. Now, when that occurs, these originators, they will go and pool these mortgages and create tranches, and they will sell tranches of this defaulted mortgage loans, and they will sell it into the secondary mortgage market. And in the secondary mortgage market, which is like a flea market, if you will, you're going to have buyers and sellers of this type of paper. A lot of hedge funds and banks will be the buyers of these tranches. And after they acquire these mortgage loans, they will make certain steps to for borrower outreach, to try to connect with the borrower, to work out payment terms, to create loan modifications, to help the borrower reinstate and essentially get back on track with their mortgage obligation. Now, the ones that are successful, the hedge funds that are successful in getting a mortgage loan back on track with a payment plan that the borrower can afford, then what they've done essentially is they've created value for that mortgage loan. So in other words, they may have purchased that mortgage loan at 30 cents on the dollar, and once it's modified and the borrower's making payments and there's seasoning to those payments, then now the value of that mortgage loan may jump up to 80 cents on the dollar. So they've created a 50-cent increase in value on that mortgage loan. Now, from that point, the hedge funds will go and bundle these mortgage loans into a pool of reperforming mortgage loans. And they consider them reperforming because they're not, fully, they did have that scratch and dent period, even though they're paying consistently now. But, since they had that first ding on their payment history, now they're lumped into a reperforming mortgage loan category, if you will. And so from that point, they will sell those pools of reperforming mortgages within the secondary mortgage market, within the RPL slash reperforming mortgage loan sector of the secondary mortgage market. And there you will find Bequest Funds. We are a large buyer of these reperforming mortgage loans. And so what we do essentially is we will source and and purchase these loans at, let's say, a 12 to 14% yield. And in turn, we will pay our investors an 8% return. So we have a spread by which to operate from, for our fund, and that's how we're able to deliver an 8% return to our investors, paid monthly, because the whole idea is we receive monthly payments from the borrowers. So why should we hold those payments back? Why should we pay someone quarterly when we're receiving money monthly? So the whole idea is receive the borrower payments in monthly and pay our investors on a monthly basis. So since we've been doing this, operating in this secondary mortgage marketplace for the past 8 years, we have never missed an investor payment. And we've also never had to back out of any trades that we've committed to. So having that reputation, having that, having that longevity in the industry has equated to a lot of unique deal flow that comes our way, a lot of relationships that have built, that have been built over the course of time, and couple that with, 4 books written in the industry. Myself, I speak at industry events around the country, and so so I'm recognized from that perspective as a thought leader. So it is, this industry has been incredible. As you can see that, I come from that distressed background where I understand, what it takes to help a homeowner get back on track if they've missed payments for the past 4 or 5 years. And I've also, we also operate by which we manage loans that are in a performing state, making sure that we have strong relationships with our borrowers, as at the end of the day, I mean, they are our customers. That's how we view it. So the people that invest with Bequest Funds, our income fund, as well as the borrowers, those are our customers, and one should always treat customers like gold, and that's what we look to accomplish. So how Bequest Funds works? Well, first off, as I mentioned, we manage a diversified portfolio of residential mortgages across the United States. So we look at, yes, we understand there's certain pockets within the country that are doing better economically than other parts of the country. However, at the end of the day, we are looking at property valuation. We are looking at trends in the real estate marketplace from a macro perspective, but we are also focused on that particular borrower and their ability to pay. So that's very important. We have a proprietary underwriting model that is really born and bred on the distress side. So we actually look at performing mortgages, and we mentally take them through a process as if they're distressed. So with the most, utmost skepticism, and we are scrutinizing, we are acting as if we're taking that property back through foreclosure, even though this borrower is performing. And that helps us keep sharp. We're understanding property valuation. We are looking at the lien situation through title reports, other encumbrances, credit reporting. So we understand, who the borrowers are paying, what type of consumer they are. We do skip tracing. So we do a whole host of underwriting. We have an extensive underwriting criteria that's very sophisticated and technology based. And I know Sean's going to kind of touch on that a little more, as he has brought a great deal of sophistication to that underwriting process, to Bequest Funds. Now, in terms of the business model, it's very simple. We buy strong performing mortgages from the secondary market space. So these are mortgages that are seasoned, where the borrower has shown that they can make their payments on time over the course of a good amount of time. And we take those monthly payments and we turn around and pay our investors on a monthly basis. And we also have a compounding option for investors that want to set it and forget it, have it compound at 8.299%. However, the choice is up to that investor. For us, it's, either way is good. We're just happy to have an investor partner into the fund. Now, in terms of the collateral, Sean will touch on investment to value ratio, which is very significant with our fund to ensure that there is not just collateral, but we have good, strong equity coverage in case of the inevitable, and that is in case we have to go down a legal road with a borrower, that we know that we're protected, our investors are protected, in the event that we do have a default with a mortgage loan. So, at the end of the day, what our fund's objective is to provide a consistent income to accredited investors. So in terms of, what the kind of the number one thing we get asked here is, how is my capital protected? One knows that, yeah, hey, you can put in, 100,000, 500,000, and you know that you're going to receive the monthly payments, via ACH or wire on a monthly basis. But how is one confident that they will receive their capital back when and if they get to a point where they have to pull their money out, some or all of their money, I should say? Well, we critically assess the notes that we buy, given that underwriting criteria that I mentioned. That our team is very seasoned. We've, like I mentioned, myself personally, I have worked out over 1,000 loans, distressed mortgage loans myself. So it's not as if I am a fund manager that just comes into the space and has management experience, quote unquote, and knows all the business lingo, and I'm managing a team that is outsourced. It is the exact opposite. You have a very, the whole company is really rooted on the distress note side. So that goes for Sean and myself. And we have a team that rests with us internally. You can meet them if you're ever in the Sarasota area. Come on in. You can meet our asset management team. They talk to borrowers on a daily basis. Borrowers calling in, they're reaching out. Lots of activities going on in our office, because we are set up as a boutique outfit by which, when your loan is placed in Bequest, you will have a single point of contact by which you can call. You will have email exchange. You will have instant access to asset managers. And so it is a very relationship, customer service centric operation. So as we build these relationships with the borrowers, then we become first in mind when they have to make a payment, each and every month. And that's our whole objective. Now, we work with a default rate that's under 10%. Now, mind you, we are buying these reperforming loans at discounts. So we may buy a reperforming loan. I mentioned 12 to 14% yield. We may pick it up at that pricing in the secondary market. So let's say that we're purchasing a reperforming loan at 60 to 80 cents on the dollar. So we have a little wiggle room with our defaulted rate. So we try to keep it under 10%. We've been sitting, throughout 2020 at about an 8% defaulted rate. So we monitor this on a daily basis. Each asset manager is, responsible for goals, and they have metrics by which they're responsible for. So, and we meet with our team of asset managers on a daily basis. We have a morning meeting. So everyone comes in, 8:05. We all meet. We all discuss the metrics. that we're all responsible for. And so there's a lot of accountability within our company, and we like to keep it very tight that way. And so that everything seems very seamless for everyone else. That's borrowers paying, that's investors receiving their money on a monthly basis. So we want everything to be very seamless for our end clients. Now, we set up Bequest Funds as an equity stake. This was very important versus a debt offering. Even though the monthly distributions are paid monthly, so it's like a debt structure. However, we wanted to set it up as an equity stake so that investors would have an ownership position in Bequest Funds, so that one can feel very secure that if the event of something happening that's negative, that we can go and liquidate some of the assets and recapitalize all our investors. So that we don't foresee that happening. We monitor these loans on a daily basis, so we have a strong control over our portfolio. However, we want to give that reassurance of an ownership position to our investors. Now, our portfolio is collectively at 63% investment to value. I'll let Sean pick up now, and he'll go touch on to what investment to value means within our industry. And I'll turn it over to Sean.
Yeah, thanks, Martin. And I appreciated everyone for giving us the opportunity to tell you a little about the fund. I'm going to go through the fund structure specifically, take you through a case study of an asset that we typically buy into the fund, one of our reperforming mortgages that Martin mentioned. Take you through the portfolio, what it looks like from a national perspective, and then just show you how the fund has performed through the pandemic, because I know that's important. There's a lot of noise out in the marketplace about mortgages, and so we just want to talk a little bit about how the fund has performed. So let's get right into the fund specifically. And so this is a Reg D 506C fund registered with the SEC, and so it's considered an alternative investment fund, and so it'd be in the alternative investment class, specifically an income fund, because we do in fact pay monthly pref payments to our investors. Obviously, we collect payments on a monthly basis from our borrowers, which allows us to make payments to our investors. And so specifically, it's an 8% annual return paid out to our investors on a monthly basis. The minimum investment into the fund is $25,000. The difference between the Bequest Income Fund and many other fund structures out there is that we don't charge fees. You will in fact receive an 8% return on the capital that you contribute to the fund. We will make monthly payments to you based on the 8% return over 12 payments. The fund is in fact liquid, right? We would consider it liquid. There is a 1-year lock-in period, but after the lock-in period is over, you're free to pull the capital out. We ask for a 90-day notice on pulling capital out. This paper is very liquid in the space, and so Bequest earns income in a lot of different ways, right? We get payments from our borrowers. We have borrowers that refinance the property, which is the capital gain to the fund. We have borrowers who sell the property, which is another capital gain in the fund. And so there's a lot of cash flowing through the fund. Paper that we buy is also very liquid, and so it's no problem for us to liquidate investors after their lock-in period is over. As Martin mentioned, there's also a compounding option at approximately 8.3% return if you decide to leave your money into the fund and not take the monthly payments. We are constantly reinvesting capital. This is another big difference. When Bequest Fund buys a mortgage at a discount and that borrower decides to refinance, there's a big capital infusion back into the fund, we take that capital and reinvest it back in and go buy more mortgages. And so we're constantly reinvesting capital back into the same asset class here. And the other difference is most funds operate on a 5-year structure. This is an evergreen fund. We set it up so that investors could be with us for years and years and years and not have to worry about pulling their investment out at the end of the fund and going to find another investment vehicle. And so for us, we set this up as a long-term play. It's an evergreen fund. There is no expiration on the fund. So let's talk a little bit about how we protect your capital as an investor. And so this is extremely important to us. Our underwriting criteria, as Martin mentioned, is very proprietary in one sense, but very conservative in another sense. You know, we do a lot with technology, understanding the borrower, understanding the property, as we came from the distressed mortgage space, which gave us a lens to look through that most folks don't get to see. And so for us, we're using our underwriting guidelines that we would use if we, in the past, when we purchased non-performing loans, we use those same underwriting criteria on top of the fact that we use a 65% investment to value ratio. And so I'll talk a little bit about that when I give you the example and the case study that we'll go through next. But there's 35% equity coverage across the portfolio on the assets that we buy, and that protects investors' capital in the event of a housing recession or a borrower deciding that they no longer want to pay the mortgage. So from a reporting perspective, all of our investors receive monthly statements based on their return that they're getting on the capital that's in the fund. All that reporting is online through our investor portal. At any point, if an investor wanted to receive any of the data on the fund, they just go to our website, go to the investor portal login, and you have access to all the data that our fund produces from an investment perspective. We also we also send out monthly letters, actually quarterly letters to our investors, and so we'll provide you with a quarterly update along with financials. As I mentioned, this fund is liquid. We will allow you to redeem your investment after the 1-year lock-in period. We ask for a 90-day notice, and it is a best efforts. As we talked, the asset classes that we're buying are very liquid. The fund is producing cash, and so it's no issue for us to redeem investor capital. We talked a little about the structure already, but we are a $50 million fund. It will close out after $50 million. 1-year lockup period. We will allow investors to invest with IRA capital through self-directed IRA accounts. And there is a 60-day deployment period on capital. It takes us a few months to deploy capital. An investor comes in and we go instantly to the market and we buy reperforming mortgages. It takes about 60 days for those assets to show up on our books and start producing income. And so because of that lag in the market, we do have a 60-day deployment period whereby once you invest in the fund, after 60 days, you will start receiving your pref payment. And so Martin, if you can go directly into our case study, we'll talk a little bit about the asset class that we specialize in. So as Martin mentioned, we buy reperforming mortgages. And so just a quick definition of what that means. Basically, a borrower ran into financial challenge at some point in the past. It could have been years ago. And these are temporary issues, as Martin mentioned. It's a job loss, it's medical crisis, it's a divorce. And so these are temporary situations that cause the borrower not to pay. And so another entity, another bank, modified the terms of the mortgage and because the terms have been modified, it's now considered a reperforming mortgages. A lot of the banks that modify the terms have to sell those assets because they're required to over capitalize, they have to have more collateral backing that asset because it's a non-traditional mortgage. The terms have been modified. And so because of the cost to carry mortgages like this for a traditional bank, they unload these mortgages into the secondary market, and that's where we buy these assets. And so again, the borrower worked with another entity, modified the terms. We come along, we assess the performance of the asset, and we buy the asset at a discount in the secondary market. So let's look at this asset here in San Diego, California. We bought the second mortgage on this property. And so if you look at it specifically, this suburban house just outside of San Diego, middle American house, the first mortgage on this loan is $400,000. We bought the second mortgage, which had a balance of $167,000. The home is valued at $732,000. And so we look at the loan to value ratio, we look at the investment to value ratio. And so specifically here, the total loans on the property between the first and second is about $568,000, $567,000. And the home value again is at $732,000. The loan to value ratio on this property is 77%. So let's look specifically at the asset that we purchased. We bought the second lien. It has a principal balance of $167,000 with an interest rate of 6.125. And so a lot of investors look at us and say, you know, Sean, the math doesn't work. You're paying on an 8% return. You're saying that you produce a 14% yield on the asset. I'm looking at the coupon rate. It's only 6.125. Well, keep in mind that we're buying this asset at a discount in the secondary market. And so if you look at the strategy here, we're buying this asset at a 47% discount. Because of the reperforming loan status, the bank will sell this asset as a discount. And so we purchased this loan for $79,000, which equates to a 40% discount on the principal balance of $167,000. And so because this payment is $943 a month, we calculate yield based on the purchase price of the asset. And so we're collecting $943 a month, but we only paid $79,210 for this asset. It's an effective yield of about 14%. And so that's how we're able to produce the yield in order to pay our investors an 8% return because of the discount that we're in fact created, that we purchased the loan at a discount. And so let's talk a little bit about margin of safety here. And because we purchased the second mortgage, we look specifically at the investment to value ratio. And so when we calculate investment to value, we're going to add the senior balance of $400,000. We're going to then add the purchase price of the asset. So we're at $479,210 into this asset. That's our investment to value that we calculate based off of the fair market value. And so that's where we get at the 65% investment to value ratio that we focus on across the portfolio. If you look specifically at the margin of safety in this asset, on the $167,000, we have nearly a 200% equity coverage across the asset. And in many cases, especially right now, we're seeing a lot of borrowers refinance or sell their property. And so in this case, when this borrower decides to refinance or sell, we'll in fact receive 112% capital gain because in fact the borrower does still owe us $167,000, even though we purchased this asset at a 47% discount. And so these are the asset classes we're buying all day long from the secondary market. Most of the assets in our portfolio look exactly like this all across the US. And so let's go into what our portfolio looks like specifically. Martin, if you can go to the next slide. And so as I mentioned, all across the US, we operate in 25 states. As of January 1st of this year, we had 132 loans in the fund, and it's growing significantly month over month. But the average fair market value of the properties that we have a mortgage on is $320,000 all across the U.S. Obviously, certain markets, middle-class America, housing is a little more expensive, like in San Diego. But across the board, these are suburban houses in all across the country. The average principal balance on the mortgages that we hold is $47,000. So Martin, if you can go to the next slide here. Let's talk a little bit about the fund performance through Q3. Our Q4 numbers are due out here in another week or so. And so we're going to talk a little about Q3. Q4 looks very similar to Q3, but the pandemic has had an impact on the economy and GDP. Specifically, it has had an impact on a lot of mortgages, but it has not impacted the mortgages that we hold because we're not under the CARES Act. We do not have to provide forbearance agreements to anybody who calls in and says the word. And so for our assets, they've been performing very well through the pandemic. Let's talk a little about the numbers here. This was Q3. As I mentioned, Q4, the loan count has doubled. But as of the end of Q3, we had 58 loans in the portfolio. $47,000 was the average principal balance. Our investment to value ratio, which is what we pay for the asset divided by the fair market value of the property. The entire portfolio was 63%. If you look at the unpaid principal balance, we're purchasing the assets at 67 cents on the dollar on average across the board. So what we pay for the asset against what is owed to us is 67%. The fair market value totals across all the assets, there's houses worth over $11 million. Again, this is the end of Q3. We look at a lot of fair market value. We look at a cost of acquisition. And so as of end of Q3, which was a few months ago, we had over almost $2 million worth of mortgages purchased in the fund. We raised about $1.5 million in Q4 and deployed that. And so we're well over almost $4 million in acquisition price in the fund at this moment. And so after analyzing, we look at the portfolio, or analyzing the portfolio all the time. What we like to look at is the yield that has been created over the months. And so for us, through the pandemic, in July, we were able to produce a 15.3% yield on the assets that we purchased. We spiked up a little bit to 18% in August, and then finished out September at 16%. And so, through the pandemic, the assets are still producing high quality yield for our investors, which allows us to pay out an 8% pref to our investors. So after our discussion here, our goal is really to meet one-on-one with you. We want to understand what your investment objectives are. We want to understand how this fund might be a good fit for you. If you're in fact looking for yield, if you're looking for income, we want to understand what your objectives are from an investment perspective. And so we would gladly enjoy a 20-minute one-on-one consultation with you. We know that the Bequest Income Fund isn't for everybody. This is not a hard sale. And if in fact, we can point you in the right direction as to what type of asset class you're looking for, we are happy to do that. But we would love to have you in the fund. If you're interested in the fund and would like more information, please reach out to us. You can reach out to Martin specifically at martin@bequestfunds.com. We have our phone number here. We would love to meet with you, set up a 20-minute consultation, just discuss how the income fund might work for you, and if in fact you are interested. But thank you, appreciate your time. Thank you for the opportunity to present the fund. Have a good day.